Hello! I wanted to make a video in which I'm going to talk about a hidden danger that you may not be aware of. And this is the stock-based compensation. It's something that typically tech companies do a lot. And what does that mean in case you are not aware? So tech companies, other than paying their employees with money, cash, they do tend to give them some stock incentives. And these incentives actually stock work in this way. They actually pay employees with stock that is totally given away, like the employees don't pay anything for that stock. And the way it works is sort of like restricted stock units, as they are called, is called RSUs. The way this works is that typically in a period of 4 years, employees get allocated some amount of shares, and as the years progress, they get like 25% in year one, another 25% of that amount in year two, and so on. And so companies tend to do that a lot and allocate a lot of stock to be paid out to employees. Now, this has some advantages and some disadvantages. Now, it's generally speaking good for companies because they don't have to deploy cash in order to pay employees, and also it provides some incentives to employees. So, if the company is doing well, they are making more money just because the stock goes up. And so, this is a win win situation, right? The problem is that there is also a bad thing that can happen there. For example, picture a company like Twitter that I'm having here, which had its stock price actually go down like 50% over here. So imagine you were an employee with this company and you are holding, let's say, 200 shares at this level. Now, in order to stay with the company, you'll be like, okay, in the next couple of years, I'm gonna be getting stock, but it's gonna be worth much less. So what does the company do? Typically, the company tends to give away even more stock to employees, and this is when they actually uh, issue more shares. And take a look at the chart of outstanding shares for Twitter here. Do you see the pattern? They keep issuing shares here and issuing more and more and more. And as the stock price goes down, even more shares are getting issued. So that's a very, very well known thing that you should be aware of in case you are investing in tech. Especially this happens with tech a lot. And pretty much all tech companies, the big ones, the Silicon Valley companies like Twitter, Google, Facebook, all of those companies do that. And the other thing, which is a hidden danger that I wanted to talk to you about, has to do with the cash flow. Now, stock-based compensation is not cash, right? It's stock, and so it's accounted for that as being a stock expense and not a cash expense. Which means that in the cash from operations activities here, you will see that stock-based compensation is actually a positive number. You would think that this is a negative number, right? Because it extracts value from the company. And it does extract value from the company, but it's not cash. So what happens is that the expense is actually added on the income statement, and then it's extracted from the cash flow operations expenses. So it's added back over here. The problem is that when we're doing a discounted cash flow model, for example, this can skew our results. Just because the cash from operations here, notice that they are adding 600 million here. And so now, basically the cash from operations is the stock-based compensation. And when the vast majority of cash from operations comes from stock-based compensation, it basically means we have zero cash from operations over here. And this is a little bit of an accounting trick that you really need to be aware of. And now you see here that the company has capital expenditures of $1 billion, and then their free cash flow is already in the negative, but it's actually 1 billion here if you actually exclude the this value, the stock-based compensation. And again, yes, it's added, it's expensed on the income statement. But if you're using these values to project a company stock price, this can really skew your results here because you are not getting the correct cash flow. Really, I mean, it is actually it is kind of the correct cash flow, but this kind of input here can potentially skew your valuations. So it's something that you need to be aware of. And you can see it even in behemoths here, like Google. If I take a look at Google's cash flow statement, you will see that the stock-based compensation is about 15 billion here, and their total cash from operations is 91. So you will see in this one, they're making tons of money anyway. But the number that I'd like to use, practically speaking, for my cash from operations here, when I account for the model that I want to create, could be 15 billions less. And again, this is also part of the income statement, so it is an expense on the income statement. It's not like it's hidden, but it's a little bit of a danger just because it can skew your perception of the cash from operations that's coming in from the company. This is basically almost $15 billion coming in because of this balancing of stock-based compensation. Hopefully that gives you a sense of some accounting tricks that companies can play. And to me, this is a little bit sketchy the way they are doing this. I don't like the fact that accounting does it this way. I'd like this to be basically accounted for as an expense from forecast from operations, but technically it's not. And so it pays to really understand what these lines mean and how they are accounted for and how they can skew our results and what they are. And so another thing you see here, that the stock-based compensation for Google is actually creeping up and up and up. So they're paying more to employees. They're getting more employees. They're giving them more incentives, more stock. And so this is something that you really need to take into consideration when you're considering purchasing companies, tech companies especially, that are paying a lot in stock-based compensation. This is an expense, practically speaking. It's just not a cash expense. So keep that in mind in your next investments. Thank you for watching this one, a very short video. Hopefully that helped you a little bit understand how this works with custom operations. And if you did like this video and it helped you a little bit, please leave a like, that really helps. And in the meantime, take a look at this video that I made earlier, and it discusses Alibaba and how it compares to other well-known companies. Thanks for watching this, and I'll see you soon. Bye-bye.